Welcome back. We're in conversation with Manish Chokhani. We've been, of course, talking about the real economic impact and how perhaps at the margin India does stand to benefit. Manish, thank you for staying with us. You know, I remember the conversation with Neelkanth Mishra earlier, and he was saying that for India, the impact is not so much because we are kind of largely closed and we're not. Yeah. And at the margin, maybe you said you stand to gain, but it's through markets. I mean, the impact is going to be through financial markets. So let's just parse through some of the stuff which has happened, and let's just start with the bond market in the US. What is the, as they say, bond vigilantes are back.
Right.
They never went away. But what is the bond market telling you? Yields on the 10-year first fell to 3.8.
And now 4.5.
Now it went to about 4.75, 8, and then 4.5 now. What is the bond market telling us?
Look, the US has 30% holding of treasuries by foreign governments. And with, unfortunately, the way they have gone and kind of rubbed all governments of the world the wrong way, do you think 30% of all the refinancing which is coming up over the next 12, 15 months is going to be attractive to foreigners to come in? At 4.5%, maybe you'll be tempted, but then you'll think, what if this guy confiscates my holding of treasuries? Because they've done that to other countries, which is why you've seen not just the bond yields here, but the flight of capital away this time. Number one has been gold. But it's also gone to euro. The Swiss franc is 1.2 to the dollar or thereabouts, which the Swiss central bank, I remember, was trying to hold it within parity for the longest time. The euro, which is actually, you know, we used to call them the sick man. And Larry Summers had this thing of Europe being the museum of the world. The euro is strengthening because that capital is going back, because they've clearly rubbed the Europeans also the wrong way. So I don't see an alternative for the US government, whenever this refinancing now starts coming up, to go back to anything other than printing. And that's the reason for what you're seeing is happening to gold, and why we think there is endemic inflation in hard assets. So when we talk about markets, the normal trend has been US weakens, money goes to emerging markets and hard assets. What Trump is doing is only accelerating a lot of these trends, which he also does want a slightly more competitive dollar. But if you get this rise in gold, silver, uranium, copper, whatever at one end, and real assets like factories and real estate, it's a decadal move. It's not a 2-month, 3-month kind of move. And I think you'll see substantially higher gold and silver prices. And again, with lower oil, higher gold, again, events seem to be conspiring to
But this runs contrary, Manish, to what they started out. I mean, they wanted lower cost of borrowing. Look, so in that sense, last week has been a defeat.
See, they want to square the circle. You can't have kind of a forced recession in the US, which is what they need to do to crunch the current account. They need to move a lot faster on Doge to get the expenditure side down, which has not been happening at the rate one anticipated originally. Because if you get that expenditure cut and you get some of the income from this tariffs, then you have room for a giveaway, because his next game was, I will pander to my base by saying up to $150,000, no tax. And I will just put a sales tax. And therefore, only the rich buggers who are buying stuff will pay for it. So, like I said, there are so many moving parts. The world's not sitting idle while US plays the game they want. So people have been reacting, and therefore I think they'll get into a bit of a corner where I think this QE number, whatever infinite number which is coming, at some sense comes again, which is what gives you this inflation in hard assets and emerging markets.
So higher yields, you think, in the US?
Well, US can print its way out. And what that just means is your reserves are going to get smashed in real terms. And therefore, all the central banks for the last 2-3 years, it's not new, have been running helter-skelter to go and stock up on gold. And the gold number is still very low. Historically, pre the Bretton Woods breakup in the 70s, gold used to be like 60% of people's reserves. They are probably at 15.
Much lower.
So there's big headroom to go here. The younger crowd and the non-aligned crowd may say we want to go to digital currencies, Bitcoin and others. China has already made its digital currency. They've made their own version of SWIFT, which has been spoken about a lot. So it's a dismantling of the old architecture and plumbing of the world, like I said. There's something we were speaking about when we were in the conference together, which Sharad Sharma puts very elegantly, that if you don't own the standards and protocols, you will not be able to build the platforms on top of them. So all you'll be doing is then playing on the application and product layer and maybe the service layer, which is where India has been traditionally playing. China has understood the game and gone down to the depth. where they are setting the new protocols and standards, whether it's for EVs or whether it's for these payment mechanisms, for industry after industry. Like they control a lot of the critical industries of the future, the critical rare earths of the future. And therefore they've gone and built their own platforms and kept the Americans out from their walled garden. Which is why when US says we won't allow you to buy semiconductors, they can still come out with a DeepSeek.
Absolutely.
So I mean, that game is still, we're 10, 15 years behind, but that's the only way we'll have to go.
Okay, let's talk about equities. Where does all of this leave equities in that sense?
So, if whatever I'm saying plays out the way I think it does, it is again a gush of money coming towards emerging markets and hard assets. It's consistent with our markets then having a holding pattern for next at least few months while we figure out what are the new assumptions to plug into our spreadsheets and so on. But post that, there should be a big breakout in emerging markets. The CRB index also looks like it's about to take off. Gold, silver, uranium, you have to go into nuclear and stuff for powering all your data centers and additional power requirements. Europe is going to go into rebuild mode for its defense and its factories and so on, which is again hard assets. So all the old industrial companies which we I remember I'm looking at some European companies and the names which pop up are like the old used to think of Alfa Laval in America, Ingersoll Rand, and those names look like they're ready to run.
When you say money comes, gush of money into EMs, that is China as well? Or you think it's
so, well, the Chinese government's propping up their own market and they're very clear they want their market because they need a wealth effect after property got smashed. So the Chinese market is exhibiting great resilience. China performs actually, but what's happened is post the September stimulus which China gave, the global money started going to China. And India was expensive at that point, and that's really the big 30-40% correction we got over here. And most of the Trump correction, I think, is already done and we are back to where we were. Because I think market is realizing that we will end up on a better side over here. But from a global perspective, if global money is not going to go into China, at least from America, question is which way do the Europeans swing now? Because they are in a bigger mess. They can't do without China. And they don't have the defense which America has. They don't yet have the currency in the world. So if China plays I mean, its cards well with Europe. And India says, we are Vishwa, Mitra, and we are friendly with America and with China. Chinese market is actually very, very cheap, and they actually are incredible companies and incredible technology leadership in the world over there. So I may not love them as a patriot, but as an investor, you can't deny that countries.
Any sector, banking, financial services has always been something you like.
So banking is the leader of this this cycle, and the way things are aligning in the world, this sector is, I think, still going to be a very, very large wealth creator. I don't know if I spoke with you earlier. If you take the 2027 numbers, not 26. The numbers of all the banking sector stocks will exceed the erstwhile leadership from the IT sector stocks with greater stability and greater terminal value. And therefore, does the multiple from one sector apply to the other? Because in some cases, we had abandoned this price to book, right? When earlier we used to talk about HDFC or Kotak or Bajaj Finance, we talked in terms of PE multiple and not price to book multiple. Then we went through a phase where we are still talking about price to book multiples. I think the PE scenario will start coming back for a lot of these companies. And then we'll go forward and we'll discover SOTP, that they also have insurance, they also have AMCs and so on and so forth. So it plays out, it's a normal cycle. So just have patience. I mean, on balance, we are in good shape as a country. 6% band hai GDP ka. So you're not going to go to 8 suddenly, you're not going to collapse to 4. It's a holding pattern. Until we get this new stimulus coming in, that catalyst is required to kickstart. The government's played its part. You've got the fiscal stimulus.
Last time we spoke, you said you need this exact thing. I mean, you need a new source of wealth effect. And maybe precious metals, I don't know. I mean, is that...
Well, one sector takes off and then that animal spirit spreads. Today...
that is missing.
It's like, the average industrialist is like, should I go in this direction? Should I go in that direction? Will policy change? What will happen? Will I get the support? I think stars are aligning. We just have to be patient, I guess. We can't have a bull market every single day of the year. Sometimes it's good to just pause and reflect after a good meal. 4 years you had a good meal. just do a detox for a while and then take it from there.
So just to recap this for our viewers, you're saying a few months of holding pattern, ranged market.
I'd hope so.
Yeah, right?
Yeah.
And then and then maybe the market looks more constructive, basically.
Yeah, this market wants to go up.
Yeah.
We're not giving them enough reasons because that has to come from earnings. When you're doing a single-digit earning growth, you can't say at 20 P we're like okay market. Some earnings come and then we're off to the races, and it'll still be very specific. I don't think the tidal move across sectors happen because in typical periods like this, you separate the men and boys as well.
Manish, absolutely great conversation. Thank you very much for your time. Thank you for coming down.
Thanks for having me.
Well, that's it from me. Thanks for watching. Manish Chokhani with his views on global markets, global macros, and more. Thank you.